let's talk about the financial capital market. Now, you probably heard of the word capital before, and you thought that was money, and that would be correct if you are outside of economics. But in economics, we use financial capital to talk about money, because in economics, we use capital as machinery and tools. So very important key thing about that is financial capital is money, capital is machinery and tools. But we will follow the same laws of supply and demand as before, but now, because we're dealing with financial capital, we're going to be dealing with an interest rate. Now, interest rate is the price of borrowing in the financial market, or it's the gain you get from saving in the financial capital market. So, since we're following the laws of demand, whenever interest rate, we're going to use R for the interest rate. With the laws of demand, you are trying to borrow money for a car, for a house, for a business, something like that. And if the interest rate is higher, can you afford as much of a loan as before, right? Let's say you're looking at a loan for $30,000 car, and then all of a sudden the interest rate is higher. So now that changes your budget. In fact, you're probably going to have to decrease the amount of financial capital that you're looking for. Same thing with the laws of demand. Higher prices, lower quantity. The same thing is happening here. Higher interest rates, lower quantity. Now, on the financial capital supply side, the suppliers of the financial capital are called savers. So for them, a higher interest rates means you get more money earned for your savings. Okay? If you ever go to a bank and you deposit money in a savings account, they will give you money for saving with them. All right? And the idea is whenever they increase the interest rates, you are inclined to save more, to earn more on the savings. So just like the law of supply says, higher prices, higher quantity, for the financial capital market, in terms of the law of supply, higher interest rates do lead to a higher quantity of financial capital. You have more people depositing money in the banks. Okay? But for a demander of financial capital, a borrower, the higher interest rate means it costs more to borrow, so people will get less loans. And we do see this in terms of a macro economy, where if interest rates are higher, we see less people investing in businesses. We see people taking less house loans, less car loans, because it's so expensive they can't afford it. And so that is something that the government does monitor, is interest rates. Right? Now, when you're saving money, you are collecting what is called a rate of return. Rate of return is basically how much are you earning for your savings. That's a fancy way of saying your interest rate. Okay, a rate of return can also apply to a business. All right, so if I were to write down the equation for rate of return, it's basically how much you're profiting off of your investment. Okay, so for instance, if you're making profits of $5,000 a year and you invested $20,000 in a business, if you were to calculate your rate of return, so this is $5,000 every year for your $20,000 investment in your business, your rate of return would be 5,000 over 20,000. And if you were to do the math on that, you would get 25%. This is why a lot of people get into business, is because they think they can get that high rate of return off of that. Okay? So this is their MB, their marginal benefit. So if you wanted to start a business and you were doing your calculations and you see here you're going to be making 25% off of your investment and you wanted to get a loan to start a business, we got to look at the marginal cost. So let's say a bank is going to charge you 10% interest for the loan. Do you go through with this? The answer is yes. Your marginal benefit, 25%. You're getting 25% and it only costs you 10%. So you do the investment, right? Now, if you are borrowing money, right, you do have to pay it back. Like in this case, you do have to pay the 10% back. The same thing happens with credit cards. Credit cards have an interest rates anywhere from 20 to 27% per year. The same idea applies there. Whenever their interest rates are higher, you're likely to use that credit card less. Okay. There is a price ceiling on interest rates, like credit cards. It's called usury laws. Usury laws could be as high as 30%. So, looking at the average rates, which are 20 to 27, and your price ceiling is at 30, this isn't doing anything, right? Like the maximum they can go is 30, but they're at 27. So, this is a non-binding price ceiling. Okay? So, this is something that we have to consider from a borrower side and a saver side. From a saving side, right, you need to look at it as what else can you do with your money? Like if you can't earn anything for your money and you want to put it into a bank or a certificate of deposit, which pays a little bit higher interest rate, then you can do that, right? And in general, whenever we see higher interest rates, we see people saving more. Okay? So really the shifts in supply and demand for the financial capital market come down to what is called the intertemporal decision making. It's basically deciding when to consume goods, now or in the future. If you want to consume goods now, you need to demand more money now, so you'll be a borrower. If you want to consume goods in the future, you will save more now. Okay? For example, in the technology boom of the 1990s, many businesses became extremely confident that investments in new technology would pay a high rate of return. So what happened? They were looking at their marginal analysis, and they saw they were going to be earning 25% by investing in technology. And then they borrowed money at, let's say, 10%. And by doing this, they gained extra, right? They borrowed at 10, made 25%, they gained a profit, okay? And because they wanted to consume now. So because a new booming industry is happening, we will see more demand for financial capital, all right? What about college? If a lot of people want to get into a new industry such as cybersecurity, right, you will see more students going to school. So what? They're going to borrow more money for the school. So higher demand for financial capital. What about foreign countries? On this one, right, because you're getting paid an interest rate for savings, you want to get paid the highest interest rate. So what if another country pays you a higher interest rate than in the US? Well, you're likely to move your money out of the US and into that market. Let me show you real quick what that looks like on a graph. Okay, so here is US banks. All right, we have a demand for financial capital, a supply of financial capital, and in the US they're paying 5% for savings. Okay, that's pretty typical, is 5%. Now let's say another bank in Europe has their supply and demand, but they're paying 7%. Would you rather save at 5 or 7%? All right, you would rather save at 7%. All right, so by doing this, you're going to take your money out of the US, decreasing the supply, and then move it into Europe's financial capital market. Okay, so this is how foreign countries play a factor in this economy, in that you want to get paid the higher interest rates. So this is why, in general, interest rates will definitely equal out to create like an overall market rate. Otherwise, we're constantly going to have these movements happening. Okay? Another reason why we would be demanding more financial capital would be starting a business. If we have more people that are optimistic and want to start a business, the demand for financial capital is higher. Okay, So this is in general of all of the ins and outs of the financial capital market. All right.